Hello everyone, welcome back to the Research Analyst series of NISM. So in previous video we were covering the chapter 2.4.2 institutional participants, and our current topic is 2.4.3 retail participants. So let's start. Retail investors include individual investors who buy and sell securities for their personal account and not for another company or organizations. High net worth individual or ultra high net worth individuals are individuals investors who invest large sums of money in the market. Reserve Bank of India has also granted general permission to non-resident Indians or NRIs, person of Indian origin (PIOs) and qualified foreign investors (QFIs) for undertaking direct investments in Indian companies under the automatic route. Next topic is proxy advisory services firms. So proxy advisors advise investors in relation to exercise of their right in the company, including recommendations on public offer or voting recommendation on agenda items. And investors may not be able to track shareholder announcements of their investing companies or analyze each of the proposal in depth, the service of proxy advisors add value to them. Proxy advisors analyze voting proposals and how it affects the interest of the investors and eventually suggest how they should vote. Proxy advisors are typically engaged in institutional investors to advise them on matters that come for voting. Our next chapter is kind of transactions. So we may undertake several kind of transactions in the securities market, ranging for immediate settlement to the distant settlement. Transaction types also vary based on transactions in the stock market or outside the stock market called OTC trades. A brief description about different kinds of transaction is given here. First one is cash or tomorrow and spot trade transaction. So cash trades are the trades where settlement, payment, and delivery occurs on the same trading day. T plus 0, where 0 defines the time gap between the days between trade day and settlement day. Cash trades in financial markets are unusual as most contracts are settled between 2 to 3 days from the date of trade. Though Indian stock exchanges have gradually started moving for all stocks into T plus 1 settlement cycle. However, we see cash transactions in our normal day-to-day life all the time when we buy groceries, vegetables, and fruits from the market. Tomorrow, term trades are the trades where settlement, payment, delivery occurs on the day next to the trading day. That is T plus 1, where one defines the time gap in days between trade and settlement day. Some of the transactions in foreign exchange market (FX market) settle on T plus 1 basis. Spot trades are the trades where settlement, payment, and delivery occurs on the spot date, which is normally 2 business days after the trade date. Equity markets in India offer spot trades. FX markets globally by default offer spot transactions in the foreign exchange. Next topic we have is forward transactions. So what is a forward transaction? Forward contracts are contractual agreement between two parties to buy or sell an underlying asset at a certain future date for a particular price that is decided on the date of contract. Both the contracting parties are committed and are obliged to honor the transaction irrespective of price of the underlying asset at the time of settlement. Since forwards are negotiated between two parties, the terms and conditions of contracts are customized. Those are over-the-counter contracts. For example, a farmer agrees to sell his produce of wheat to a miller. 6 months later, when his crop is ready at a price that both counterparties agree to. This is an OTC executed forward contract. It can be settled in cash or result in actual delivery of wheat. The settlement terms such as quantity and quality of the wheat, the price of the payment terms, reference benchmark in case of cash settlement of contract, etc., are decided by the counterparties at the time of entering into contract. These contracts carry counterparty risk if either of the parties in the trade fails to honor his side of the contract. Therefore, these contracts are generally entered between known parties and leans on informal protection mechanism to ensure that the contract is honored. The forward markets in commodities in several parts of India are based on mutual trust and are functional despite the risk involved. Next topic we have is futures. So futures are standardized exchange traded forward contracts. They are standardized as to the market loads, traded quantities, quality, and terms of delivery date, cash settlement, or physical delivery, etc. As these contracts are traded and settled on a stock exchange, and the clearing corporation provides settlement guarantee on them, they are subject to stringent requirements of margins by the clearing corporations. Future contracts are available on variety of assets, including equities and equity indices, commodities, currencies, and interest rates. For example, wheat futures traded on the Multi-Commodity Exchange (MCX) of India has the following specifications, among others: trading units 10 metric ton, minimum order size 500 metric tons, maximum position per individual 5,000 metric tons, quality standard mill quality as specified by the exchange. Contract begin date 21st of the month. Delivery options physical delivery only. And delivery date is 20th of the month. Delivery center is exchange approved warehouses. Next topic we have is options. So we will cover this topic in our next video. That's it for now. Thank you.